Welcome to PIMCO Pod. In this episode, we discuss why surprise, rather than stability, may be the defining feature of 2026 as policy volatility reshapes markets and investment opportunities. Stay tuned after the conclusion of the podcast for additional important information. Expect the Unexpected by Mark P. Seidner and Pramil Dawan. Our most pointed advice for investors in 2026 is simple. Expect the unexpected. Barely a month into 2026, markets have already weathered multiple bouts of rolling, event-driven volatility. Geopolitical surprises and policy pivots have triggered sharp price moves from the U.S. to Japan to Europe, from sovereign bonds to currencies to mortgages. Often, markets quickly reacted to headlines, and then just as quickly reversed course. In prior cycles, geopolitical foundations seemed more steady and central banks telegraphed moves quarters in advance. Today, fundamental uncertainty around discretionary government actions is driving volatility. We expect the pattern of surprises, price swings, and fast-changing market narratives to persist, and investors will need to adapt. The fragmentation era. For decades, investors relied on a stable global system built on open markets and shared policy norms. That framework is breaking down. Indeed, Canadian Prime Minister Mark Carney, a former member of PIMCO's Global Advisory Board, warned of a rupture in the world order at January's World Economic Forum. Long-held assumptions about trade, fiscal discipline, institutional independence, and global alliances are all being tested, a transformation we anticipated in our 2025 secular outlook, the fragmentation era. A more fragmented, mercantilist world changes how markets work. Capital may be allocated less efficiently as nations prioritize strategic interests over purely economic ones. New risks, as well as new opportunities, can arise in markets historically viewed as stable. Gaps between winners and losers are likely to widen among countries, sectors, and companies. Fragmentation expresses itself through higher dispersion and a greater sensitivity to policy shocks. Such conditions reward active security selection over broad market exposure. Case study: the U.S. U.S. policy communication has been at the center of recent volatility. A partial list of what markets had to digest in January: a military operation in Venezuela, uncertainty around U.S. intentions regarding Greenland, an unanticipated proposal to cap credit card interest rates at 10%, a Medicare proposal to keep payments to insurers almost flat in 2027, a directive to government-sponsored housing agencies Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds. The ensuing volatility has been a source of risk. Witness the respective share price drops for banks and insurers on the credit card and Medicare proposals, and the U.S. dollar's volatility. It has also led to opportunities. We have long found mortgage-backed securities, MBS, attractive, while U.S. policy has been broadly aligned toward making housing more affordable. For more, see our September 2025 PIMCO Perspectives, a Fed housing fix that's hiding in plain sight. The day of the policy announcement, MBS spreads tightened by about 15 basis points. As seen in the housing and Medicare proposals, affordability has become a broader U.S. political theme. Investors don't want to be caught on the other side in sectors where affordability policies might be enacted. Case study: Japan. That said, policies aimed at affordability can also backfire, particularly when they run into concerns about rising government debt levels. For more, see our December 2024 PIMCO Perspectives, Thoughts from the Bond Vigilantes. In Japan, a proposed consumption tax cut triggered a bond market sell-off against a backdrop of loose fiscal policy. It was reminiscent of the UK in 2022, when a proposed tax cut sparked a bond market rout. Policies may move markets, but at extremes, markets can also adjust and even reverse policy initiatives. The experiences in the U.S. and Japan underscore a broader shift. The skills investors have long needed to navigate policy shocks in emerging markets, EM, rapid sovereign credit analysis, real-time assessment of fiscal credibility, positioning for currency volatility are now increasingly required across developed markets, DM, as well. A playbook for volatility. Markets may appear calm during stretches today, even as vulnerabilities build beneath the surface. Traditional volatility measures such as the VIX and the MOVE index can signal complacency in both equity and bond markets, even as risks rise. Investors have enjoyed a years-long bull market in stocks, fueled in large part by technology. But as AI continues to disrupt industries and the economy more broadly, the equity market volatility seen in recent days, particularly in tech-related sectors, shows just how uncertain the outlook remains. This isn't a year to sit on one's hands and hope volatility disappears. Instead, 2026 calls for an agile mindset built for uncertainty. Be cautious and disciplined on valuations. U.S. equity valuations continue to appear stretched, leaving little cushion and greater susceptibility to sudden swings. Watch out for signs of market complacency. Make greater use of relative value strategies rather than directional bets. Stay flexible across regions, not just sectors, with the ability to move capital decisively and find value, particularly when attractive yields are available in many countries. Be nimble enough to react quickly when volatility creates dislocations, whether in Japanese government bonds, U.S. agency MBS, or EM sovereigns, leveraging global scale and local presence to identify opportunities. In a world of frequent surprises, the greatest risk may be static positioning. Portfolios built for adaptability, global, liquid, actively managed across both DM and EM, stand to capture opportunities that passive, domestically focused strategies can miss. Thank you for listening. That was Expect the Unexpected. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.